Hi, and welcome to this week's Stockscores Market Minutes for December 21st, 2015. All right, let's talk about this idea of stop the madness. You know, madness is doing the same thing over and over and over again and expecting a different result. And many traders do this. They apply the same approach to the market and yet don't succeed. And they think, well, if I just do it some more, or if I try a little harder, maybe I'll get a different result. The reality is, if your strategy is failing you, you need to stop doing it and try something else. Now, that doesn't necessarily mean throwing out the strategy altogether. Sometimes I'll make a minor tweak or change to a strategy and find that that adds value and that makes it more successful. The market is always evolving and strategies will go hot and cold. I'll have, certain strategies that work really well, and then they'll just stop working because the market dynamic changes. And that's why I have an arsenal of more than one strategy, because I will evolve with the market. So if you're doing the same thing and you're expecting a different result, you're getting a little crazy. And so I want to make the point, always evaluate what you're doing. And doesn't mean you won't have losses, doesn't mean you can go through a cold streak. But at the same time, if over and over again your approach to the market isn't working, something needs to change. All right, well, let's get into this week's analysis. Here's the chart of the S&P 500 for the 30-day, 60-minute time frame. And you'll notice that when the Fed announced the raise in interest rates right here, we actually had a pretty good rally on that. And I think a lot of that was due to simply everyone expecting the rate increase, everyone thinking that was bad. And then because the market had already kind of priced that in, you had a rally. But the following day and into Friday, we went back to the way the market had been for some time, and that was really the focus on oil. And oil was weak through the week. It went to new lows this week, and that's what led to the drop at the end of the day on Thursday, followed by the big gap down. And we're now in this pattern where we have widening volatility. If you think about it, over here we had pretty narrow volatility, and we had some big volatility there, but it's actually getting wider. These lines are diverging away from one another, and that is a sign of uncertainty. It shows that investors are getting more and more concerned, more and more uncertain. And although we don't have a major breakdown yet, I do think we have to keep a close eye on this. Now here's the weekly chart, and this is a 3-year weekly. And what I want everyone to notice here is that we've got this falling top from this previous high. Again, this is a weekly time frame. And we're just starting to get through this little upward trend line. Now, if we were to show a 5-year chart, we would have an upward trend line that sort of goes like this. And so we're still above that 5-year upward trend line. It's actually more along that line there. So we could, however, threaten this long-term upward trend line. If we get a couple of bad weeks, we could break that 5-year upward trend from a falling top, and that would be a strong sign that there is further weakness ahead. So at this point, I don't think we have to get too concerned yet, but I do think caution is warranted, and I want everyone to be careful as we go into the end of the year. On the Russell 2000, we see that issue again, falling top. All right, so we had the highs in the summer, a falling top last month, and again, we're threatening this upward trend line of support. If we break down through this, it could get ugly real fast. Now, of course, we could also bounce off of the upward trend line, which is what tends to happen, but I'm real concerned about that falling top and how that might trigger some more weakness if we get a breakdown. Now, the TSX actually outperformed the U.S. markets this week, mostly because they were just really heavily oversold. You've had oil falling, you've had obviously mining stocks falling, and it felt like they just got a little oversold in here, and we actually were stable on Friday while the U.S. market was down. But big picture, this is still a market in a downward trend on that time frame, and if we go to the weekly time frame, you can also see that we are below that downward trend line. We're at support, and we managed to close above the highs on Friday, but if we break down through there, we could test some of these old inflection point lows, and so we should be pretty cautious with the Canadian market as well. Now, if we get a break up through that downward trend line, well, that's the start of something new. We'd have to build some rising bottoms and then maybe work on a turnaround. But for now, I don't think that's the probable outcome, and I would be pretty cautious with the market going into next week or the next couple of weeks. The U.S. dollar, big reason for the weakness in commodities. You can see we broke the downward trend line there. We had some weakness in here when The European Union didn't drop interest rates as much as expected, but the US dollar actually closed above its open this week. That's why that candle is green. We're building rising bottoms, and that points to probably the US dollar moving up into this zone and testing those highs. So the bias on the US dollar is up right now, and therefore you should be fairly cautious with that. Gold, US dollar strength. Gold is going to be weak, and you can see we remain in that downward sloping channel. We're getting near the bottom of the channel, and what we've seen over and over again, get to the bottom of the channel, get a little rally. Get near the bottom of the channel, get a little rally, get a little. And these are tradable rallies for, day and swing traders. Longer term investors should not be in gold right now, but short term traders can play those little bounces up and down as this market for gold oscillates inside that downward sloping channel. Oil chart, I've made this a daily chart this week just because I wanted to show how we had that breakdown through the lows of August, and we're really down into that downward trend, getting a little bit oversold, and therefore probably due for maybe a little bounce back in the short term. And those bounce backs, you can get 10, 15, even 20% rallies in some of the oil stocks when that happens, but that's a day trader or a swing trader rally. The big picture, longer term traders, you want to be out of the oil market as well until we can break the downward trend line from a rising bottom. All right, VXX, which is our old fear index. Of course, this is based on options or futures volatility of the S&P 500 futures. And we had a break here, and we pulled back. We've built a rising bottom, and then, of course, the VIX rallied again on Friday. This is another strong sign that warrants caution for the overall market. This points to a greater chance that we are going to see more weakness in the next few weeks here because the VIX rallied off of a rising bottom, and this could get back into the situation we had August, September when we had a fairly substantial correction and the VIX really rallied. This is the thing you want to trade. If the market goes into correction mode, trade the VIX. The VXX is one, UVXY, TVIX, and it'll oscillate up and down. You can buy the VIX, buy the XIV, buy the VIX, buy the XIV, but we're back into sort of the buy the VIX mode going into next week. So my outlook then, bearish still on short and long-term time frame for both US and Canada. Gold, bearish. I've been bearish forever. Oil, bearish forever. Sometimes on the short-term time frame we can get bullish in the midst of a long-term bearish phase, but that is a very short-term trade. So stocks responded well to the initial raise of US interest rates, but then we went back to that focus on the weakness of oil, and we had the sellers come back with power on Friday. I continue to believe that caution is warranted as the charts are slowly building negative momentum. Oil prices falling to no lows are not helping. That's a real drag for the market. They are pretty oversold, but there's no sign of a bounce yet, so I want you to stay cautious. Well, that has been the Stockscores Market Minutes for December 21st, the last one of the year. We'll be back in the new year, so taking a little break as we go through the holidays. I want to wish everyone a happy holidays. Have a great couple of weeks in the market, and we'll see you in 2016. Trade well.